History doesn't just repeat, it hunts. A hidden pattern has wiped out empires, collapsed currencies, and erased entire generations of wealth, 6 times in the last 1,000 years. And for the first time, every sign shows we're entering that pattern again. Every crisis you've heard of, the Great Depression, the inflation storms of the 1970s, the 2008 collapse, the 2020 shutdown, even the panic cycles happening right now, these weren't random. They were symptoms of the same recurring force. But here's the disturbing part: while millions were losing everything, while systems were collapsing, while governments were rewriting the rules in desperation, 3 positions quietly survived, not by luck, not by timing, but because the pattern itself protects them. Today, we're going to uncover these 3 positions. But before we reveal them, you need to understand the force behind the pattern, because without that, the survival of these positions won't make sense. And when the next reset hits, most people will be wiped out simply because they never learned what you're about to hear. It all begins in 1929, a time when America was convinced it had discovered permanent prosperity. The Roaring Twenties had created a new belief that growth only goes one way up. Factories were booming, new technologies were exploding. Banks were lending like there was no tomorrow. And the stock market, people believed it couldn't fall. Investors mortgaged their homes to buy stocks. Banks lent money to anyone with a pulse. Newspapers cheered every record high like it was a new sunrise. Everyone was convinced the system had become invincible. But when a system depends entirely on confidence, all it takes is a single spark to burn it down. And that spark arrived in October 1929. Within days, markets collapsed. Within months, businesses collapsed. Within years, the entire global economy collapsed. Millions lost their jobs, savings, homes, everything. Banks failed by the thousands. People lined up for bread. Families broke apart. But underneath the destruction, a pattern quietly showed itself for the first time in the modern era, because while stocks died, while real estate died, while bonds collapsed, while cash lost purchasing power, 3 positions didn't just survive, they stood untouched. They survived not because investors were smart, not because someone predicted the crash, but because these positions were built on principles that do not break even when nations do. But history has a cruel sense of humor. Because once the crisis faded, people forgot. They ran straight back into the same assets that had betrayed them. And governments, desperate to prevent another collapse, created a new monetary world, Bretton Woods, a grand redesign of money itself. A promise that the system would never fail again. But beneath all the new rules, the same weaknesses remained, the same incentives, the same political pressure, the same fragile structure. And the 3 crisis-proof positions kept quietly waiting in the background for the next breaking point. The next breaking point didn't come slowly. It arrived with the force of a global political earthquake. Because the new monetary system created after the Great Depression, Bretton Woods, was already cracking long before anyone admitted it. It was built on a promise governments could never keep. A promise that every dollar would be backed by gold, even though the government kept printing more dollars than gold in its vaults. For a while, nobody noticed. The economy grew, trade expanded. America rose as the uncontested global superpower. But behind the scenes, pressure was building. The US was spending more than ever. Militaries, foreign bases, global reconstruction, welfare programs, political commitments, money flowing out faster than gold could come in. Countries slowly realized something terrifying. America was printing promises it couldn't fulfill. So they began asking for gold instead of dollars. That's when the illusion started to crack. First France asked, then Britain, then other nations. Gold reserves drained, confidence shook. And for the first time since World War II, the world doubted the dollar. The United States now faced a choice: shrink the currency system to preserve gold, or abandon gold to preserve the currency. In 1971, Nixon chose the second option. He closed the gold window. The dollar was no longer backed by anything. Every currency on earth became just paper backed by nothing but trust in politicians. People don't realize how big that moment was. It wasn't a policy change. It was a full reset of the global monetary system. Economists call it Nixon shock, but in reality, It was the start of a new era, an era defined entirely by debt. The moment gold backing disappeared, governments were finally free to borrow, free to print, free to spend without limit. Debt soared, inflation rose, the value of savings quietly died. Most assets suffered, cash melted, bonds lost real value. Stocks stagnated for years, real estate struggled. But those same three positions? The ones that survived 1929, once again, they stood firm. One of them didn't just survive, it skyrocketed more than 1,000% during the decade when most assets were suffering. But nobody paid attention. People were too distracted by something else entirely, the rising cost of living. Prices didn't just rise, they exploded. Wages couldn't keep up. Food, fuel, homes, education, everything became more expensive. A single paycheck now bought less than it did a month ago. Savings accounts were punished, retirements were destroyed. And this created a realization: economic pain doesn't come from the crash. It comes from the recovery. The crash removes what you had. Inflation removes what you can earn. But even as inflation burned the world, the pattern remained consistent. The same three positions protected purchasing power. The same three positions avoided destruction. And the same three positions quietly rewarded anyone who held them. Yet again, society forgot, people moved on. And the next generation walked straight into the next crisis, 2008. The 2008 crash wasn't just a housing bubble. It wasn't just bad loans, it was something deeper. A system built on endless debt had finally run out of room. Banks were lending money that didn't exist. Homes were being sold to people who couldn't afford them. Wall Street was packaging risk as safe. Governments looked the other way. Then the default started, foreclosures spread, markets panicked. Banks collapsed one after another. Lehman Brothers fell, AIG fell, the entire financial system froze. And for a brief moment, the world was hours away from a full global shutdown. People lost homes, people lost retirement funds. People lost jobs, but the three positions. For the third major crisis in a row, they held their ground. One of them even surged during the panic, another one stayed stable when stocks were collapsing. The third one increased its purchasing power as currencies weakened. This is the moment the pattern should have become obvious. Three different eras, three different crises. Three different causes, yet the same survivors. And then came 2020. This crisis was different, not economic, but biological. A virus, borders closed, travel stopped, factories shut down. Markets collapsed in days, fear spread faster than the disease. Governments responded the only way they knew how: printing money, stimulus, relief packages, bailouts, record-breaking debt. More money was created in a few months than in decades before. The consequences were predictable: asset bubbles inflated. Inflation surged again, currencies weakened, savings eroded. But the three positions, once again, they survived. One of them skyrocketed to all-time highs, one acted as a defensive shield. One created passive income during a period when millions were unemployed. At this point, the pattern isn't a theory. It's a fact, a repeatable force, a law of economic gravity. Crises change, governments change, technology changes. But the pattern and the three survivors do not. And here's the part most people never understand: these positions don't survive because they're safe, they survive because they benefit from desperation. They survive because they exist outside the structure that collapses. They survive because they represent something governments cannot print, manipulate, or fake. And now we reach the most important part of the story, where we are today. Because all the signals are back, the same indicators that appeared before 1929. The same imbalances that broke the system in 1971. The same excesses that triggered 2008. The same monetary distortion that defined 2020. All of them are happening again, but this time, they're happening simultaneously. Debt levels are beyond anything in history. Inflation is still embedded in the system. Banks are sitting on unrealized losses. Currencies are weakening. Housing affordability is collapsing. Governments are running out of tools. And trust globally is at its lowest point in modern times. We are not heading toward a crisis. We are already inside one, and as the cycle tightens. The world will once again rediscover the three positions that survive resets. But before we reveal them, we must understand why they survive. Because once you understand the mechanism, the force behind the pattern, new lines never look at markets the same way again. To understand why these three positions survive every reset, you have to understand what actually collapses during a crisis. Most people think markets collapse, or banks collapse, or currencies collapse, but that's not the real root. The thing that truly collapses is confidence. Confidence in the system, confidence in government promises, confidence in the currency, confidence in future stability. When confidence dies, everything built on it dies with it. Stocks depend on confidence that earnings will grow. Real estate depends on confidence that incomes will rise. Bonds depend on confidence that governments will repay. Currencies depend on confidence that value will hold. But these three positions do not depend on confidence. They exist because confidence fails. They grow when the system shrinks. They strengthen when the environment weakens. They rise precisely because most assets fall. Humans make the same mistake in every era. We assume the system will last forever. We believe growth is permanent. We convince ourselves that this time is different. But the cycle never changes because human behavior never changes. Every major crisis in history follows the same sequence. Countries overborrow, currencies weaken, inflation rises, inequality widens, political tensions escalate. Then a shock, internal or external, hits the system. Confidence collapses, the reset begins. And during the reset, everything people rely on becomes fragile. Banks restrict withdrawals, stocks freeze or crash. Governments rewrite debt terms, currencies lose purchasing power. Savings evaporate, income becomes uncertain. But the three positions remain unaffected because they are tied to forces deeper than politics, deeper than markets, deeper than governments. They are tied to scarcity, necessity, and human survival. Most assets exist only because a society functions. But these three exist even if a society stops functioning. The first position survives because it is universally desired. It has been accepted in every culture, every generation, every crisis in recorded history. It cannot be devalued by decree. It cannot be inflated by printing. It cannot be defaulted on. Governments themselves hoard it when they lose control. The second position survives because it generates something people always need. No matter what happens, depression, inflation, war, currency collapse, people still wake up, consume, move, live, function. This position taps into that daily necessity. It is not tied to optimism, it is tied to reality. The third position survives because it lives outside the system entirely. It is not a stock, not a bond, not a currency. Not controlled by banks, not controlled by any single government. It is built on mathematics, not policy. On code, not committees. On scarcity, not political promises. But before revealing them, we need to understand how this cycle is repeating today, because the same pattern is emerging at a level never seen before. Governments today are more indebted than at any point in modern history. Global debt has crossed levels even economists once believed impossible. Countries are borrowing money to pay interest on previous borrowing. Central banks are trapped. If they raise interest rates, they risk breaking the system. If they cut interest rates, they fuel inflation again. Every choice leads to pain. Inflation is not gone. It has simply changed shape. People see prices rising slower and assume things are returning to normal. But the damage is already done. The currency you hold will never regain the purchasing power it lost. Savings accounts cannot recover what inflation already destroyed. Wages have not caught up. Purchasing power is permanently lower. This is the same pattern that appeared in the 1970s. Back then, too, governments denied inflation. Back then, too, they insisted it was temporary. Back then, too, they waited too long to act. And when they finally acted, the cost was massive. But today's problem is bigger because the world is more fragile. Countries depend on cheap debt. Corporations depend on low interest rates. Consumers depend on credit. Housing markets depend on leverage. Banks depend on trillions in hidden losses the public can't see. This is why the next reset will be more intense than the previous ones. Not because the world is weaker, but because the system is stretched thinner than ever before. Another alarming sign is emerging globally: distrust. People are losing faith in institutions. Political polarization is rising everywhere. Elections are becoming battlegrounds. Economic anger is spilling into the streets. History shows that when trust dies, currency is next. And then we arrive at the most dangerous force of all: currency dilution. Since 2020, more money was created than in the previous decade combined. This diluted the value of every dollar, euro, pound, yen. And dilution always ends the same way: the system must reset. The debt must be revalued, the currency must be restructured. The economy must be recalibrated. This happened in Rome. It happened in the Ottoman Empire. It happened in the Austrian Empire. It happened in post-World War I Germany. It happened in 1971. It happened in the 1997 Asian crisis. It happened in 2008. It is happening again. Which brings us back to the three positions. These positions survive not because they magically rise every time. They survive because they are built on properties governments cannot manipulate: mathematical scarcity, physical scarcity, human necessity. Economic utility. Even if markets freeze, these positions still hold value. Even if banks restrict withdrawals, these positions remain accessible. Even if currencies collapse, these positions still trade. Even if governments restructure debt, these positions avoid default. But the most important reason they survive is this: people turn to them in fear: fear of losing savings, fear of inflation, fear of recession, fear of the future. Fear forces capital to flow into what cannot be printed or diluted. Throughout history, during every major collapse, wealthy families, institutions, and even governments have moved into the same places. These are the lifeboats of the financial world, ignored during calm weather, but priceless during the storm. And now, as the global system enters its most pressured moment in decades, the three positions are becoming relevant again. You can already see the signs in global debt markets, currency volatility, central bank activity, and institutional flow. All that's left now is to reveal the positions themselves. But to reveal them properly, we must enter the final part of this story, the part where the pattern becomes undeniable and the future becomes clear. We've followed the pattern from 1929 to today. We've watched systems rise, break, and reset. We've seen assets crash, currencies die, and entire financial worlds rebuilt from scratch. And through every reset, three positions stood untouched. Three positions that didn't just do well, they became the only places where wealth survived. Now it's time to reveal them, not as hype, not as predictions, but as historical fact. The first crisis-proof position is the oldest, the most universal, and the most quietly powerful. For thousands of years, it has outlived kings, governments, empires, currencies, wars, depressions, inflations, and collapses of every kind. It is not a trade, it is not speculation, it is the final form of trust when everything else shatters. The first survivor is physical gold, not gold ETFs, not gold derivatives, not paper gold. Actual, physical gold. Gold survived the Great Depression. It survived the 1970s inflation crisis. It survived 2008. It survived 2020. It survived the fall of Rome. It survived the collapse of the Ottoman Empire. It survived world wars. It survived every currency ever created. When confidence dies, gold becomes the anchor. When currencies get devalued, gold gets revalued. When governments lose control, gold becomes the backup plan. It is not a speculative position, it is a form of survival, but gold alone is not enough. Because gold protects wealth, it doesn't grow wealth. And after every crisis, the greatest opportunities emerge not for savers, but for those holding the second position. This second survivor is not glamorous. It is not fast, it is not flashy, but it is essential. The second position is cash-flowing real assets that produce something people need no matter what happens. Not luxury real estate, not speculative property, not over-leveraged rentals. Real assets with real demand, agricultural land, energy assets, essential infrastructure, transportation, utilities, production sites. These assets survive because people still need food. People still need electricity. People still need shelter. People still need transportation. People still need basic services. During inflation, they can raise prices. During recession, they still generate income. During currency resets, they reprice themselves. During chaos, they become the foundation of survival. This is why in every crisis, wealthy families buy farmland, energy assets, and necessity-based real estate. Not for glamour, for survival, for stability, for continuity. But then, there is the third position. The youngest, the most misunderstood, the one governments cannot shut down, cannot dilute, cannot inflate, and cannot recreate. The one built on math, not trust, on code, not policy, on scarcity, not printing. The third position is Bitcoin. Not crypto as a whole, not gambling tokens, not pump and dump coins, just Bitcoin, the only asset in digital history with a fixed supply, predictable issuance, and zero dependency on governments. Bitcoin survived the inflation wave. It survived bank failures. It survived the pandemic. It survived capital controls. It survived currency collapses in countries around the world. It survived every attack thrown at it by governments, banks, and institutions. And in the next cycle, Bitcoin becomes even more relevant because the world is now fully digitized. Capital moves digitally. Commerce moves digitally. Savings move digitally. And Bitcoin has become the digital version of what gold was for thousands of years, a store of value outside the system. These are the three survivors of every crisis: physical gold, cash flowing essential real assets, Bitcoin, three completely different forms of protection. One ancient, one practical, one technological. Together, they form the only consistently proven shield against currency dilution, political instability, economic resets, and systemic collapse, but understanding them is not enough. You need to know why they matter right now, because the world is approaching a moment where these three positions will shift from useful to necessary. Every major economic transition in history begins quietly, but near the end, the signs become impossible to ignore: rising debt, slowing growth, currency debasement, political conflict, institutional distrust, inflation waves, asset bubbles, bank fragility, a widening gap between the real economy and the financial economy. These signs are not random, they are symptoms of a system reaching the point where it must reset. The next reset will not look like 1929, or 1971, or 2008, or 2020. It will be a combination, multiple stress points converging. Debt crisis plus inflation, plus currency weakness, plus political instability, plus technological disruption all happening at the same time. This is why institutions are quietly repositioning. Central banks are buying gold at the fastest pace in modern history. Wealthy families are buying farmland and essential real assets. Financial institutions are integrating Bitcoin into long-term reserves. They're not preparing for a crash, they're preparing for a transition. Because every crisis is simply a transfer of wealth from those who react late to those who prepare early. The three survivors are not investments. They are insurance against a cycle that has reset civilizations more than once. They are guardrails against a monetary system becoming unstable. They are a bridge between the world we have and the world we are about to enter. If history repeats, and it always does, these three positions won't just protect wealth. They will define who emerges strong after the reset. So here are your final takeaways. Takeaway number 1. Systems don't collapse suddenly, they erode slowly, then break all at once. The signals appearing today are the same signals that preceded every major reset in history. Takeaway number 2. Most assets depend on confidence. But confidence is the first casualty in a crisis. This is why gold, essential real assets, and Bitcoin survive. They are independent of confidence. Takeaway number 3. The greatest danger is not the collapse, it is being unprepared when the reset begins. Preparation is not panic, it is strategy. And here's the truth most people avoid. You cannot control the global cycle. You cannot stop the reset. But you can decide whether you face it vulnerable or protected. If this video gave you clarity, insight, or a deeper understanding of the pattern, then you already think differently than most. Most people won't see the reset until it hits them, but you do. You're already ahead. Now it's your choice. Do you want more videos like this, deep dives on survival strategies, wealth cycles, crisis-proof investing, and patterns history keeps repeating? If yes, then make sure you subscribe, because this is just the beginning. And the next chapter of the global cycle is already unfolding.